If you have a car payment right now, you are likely paying upwards of $600 a month. In fact, the national average for a new car just crossed $740. We tend to blame our financial stress on rent hikes or student loans, but the math points somewhere else. That single recurring auto payment takes up a massive percentage of your take-home pay before you even have a chance to invest it. It operates quietly in the background. Month after month, year after year, your car payment acts as an invisible anchor, keeping you from actually building wealth. Let's look at two people making the exact same $50,000 salary, living in the same city. The only difference is how they handle their daily commute. Person A buys a new car. The sticker says $45,000. They finance it at 7% interest over a 6-year term. Person B buys a reliable 3-year-old used car for $14,000. They pay cash. No financing, no monthly obligations. This chart tracks what happens to their net worth over the next 6 years. Person A's car, after thousands of miles in constant use, now sits at roughly $12,000. Person B took the $735 a month they would have spent on a loan and invested it in an index fund. That account has grown to over $68,000. The auto industry keeps moving the goalposts to make these expensive vehicles seem affordable. The average auto loan term is now stretching out to 72 months, locking buyers into a 6-year financial drain. And the clock starts ticking immediately. The afternoon you drive a new car off the lot, it loses roughly 15 to 20% of its value. On a $45,000 car, that is a $7,000 to $9,000 evaporation of net worth in a single day. When you string these decisions together, trading in one financed car for the next over and over, you end up redirecting hundreds of thousands of dollars toward depreciating liabilities. A lifetime of car payments is simply a retirement account that never got built. To understand exactly how this happens, we have to look at the actual math of auto financing. Step 1 is moving past the monthly sticker price and calculating the total cost of the vehicle. This visual shows a $45,000 car financed at 7. The actual value drops to $27,000, but because of 6-year financing, your loan balance hovers around $30,000. This gap between what you owe and what the car is worth is called being underwater. Right now, nearly 30% of trade-ins have negative equity. Dealerships handle this by quietly rolling that remaining debt into your next car loan, meaning you're paying interest on a vehicle you no longer even own. Carrying negative equity from one vehicle to the next creates a compounding mathematical deficit. You start every subsequent financial decision thousands of dollars behind the starting line. Step 3 is measuring the opportunity cost. The true financial damage includes the specific growth that your monthly payment could have generated if invested elsewhere. By putting our $768 monthly payment into an index fund, the investment climbs past $68,000 over 6 years. The car, meanwhile, depreciates down to $12,000. That creates a strict $56,000 gap from one single car purchase. Repeat this error across 3 or 4 decades of driving, the capital lost to auto financing is the exact capital required to retire early. It is the strict dividing line between achieving financial independence and working into your late 60s. Step 4 requires understanding the environment where these transactions happen. Dealerships are largely in the business of selling monthly payment schedules, not vehicles. When you walk in and declare you want to keep your payment under $600, you hand over your leverage. The dealer will simply stretch the loan to 84 months to hit your target while maximizing the vehicle's final price. That extended timeline provides plenty of room to bury expensive add-ons. Extended warranties, paint protection, and gap insurance disappear into the math, adding only a few dollars a month but thousands over the life of the loan. The defense against this is strict separation. Negotiate the total out-the-door price of the vehicle first, without ever discussing how you plan to pay for it. Once the price is locked, figure out financing through an independent institution. Credit unions consistently offer auto loan rates that beat the in-house financing pushed by the dealership. The modern dealership is engineered to blur the true cost of ownership. Your most effective strategy is to strip away the monthly math and demand total visibility on the final purchase price. Step 5 is execution. If you genuinely need to finance a car, financial planners rely on a specific formula to keep the math from ruining your net worth. This is the 24-10 rule. Put 20% down to absorb depreciation. Limit the loan to 4 years. Cap all transportation costs at 10% of your gross income. On a $6,000 income, your absolute maximum limit for everything combined is $600. Where public transit is limited, a car is undeniably essential. This strict framework ensures you acquire that essential tool without severely over-leveraging your household income. A vehicle gets you to work. It does not build your wealth. True financial independence comes from what you do with the capital you rescue from the car payment trap. The single most effective financial move you can make with a vehicle is choosing to buy one that is 2 to 4 years old. This chart illustrates the logic. A $45,000 car in year 1 typically sells for around $27,000 by year 3. That $18,000 gap represents the initial depreciation hit. You are getting functionally the same vehicle, but you are avoiding the heavy debt required to pay for its first 3 years on the road. Stepping in after that initial curve flattens out uses the first owner's purchase as a financial shield for your own. Buying a $12,000 to $15,000 reliable used car in cash eliminates a monthly payment that typically ranges from $700 to $800. Investing that $700 to $800 consistently over 10 years allows it to compound into a sum between $130,000 and $150,000. This capital is generated entirely by the car decision, independent of your salary or career growth. $150,000 is enough to secure a rental property or provide a significant down payment on a home. Choosing a paid-off car over a new financed one converts a monthly liability into a 6-figure asset within a single decade. The moment a dealership runs your credit to offer a loan, it triggers a hard inquiry on your report. This timeline shows the impact. If 5 dealers run checks across several months, your credit score takes 5 distinct hits. But if these checks happen within a 14-day window, bureaus group them together. The result is only one minor reduction. This 2-week period allows you to shop multiple lenders aggressively to find the lowest possible interest rate. Using this grouping rule minimizes long-term interest costs while protecting your credit reputation. This strategy works without needing a 6-figure income or complex market timing. Since car ownership is nearly universal, it remains one of the most accessible financial levers for the general public. Most consumers commit to new car loans on autopilot, agreeing to monthly payments without ever calculating the long-term cost. Pausing to run these numbers creates a compounding advantage that changes your financial trajectory over time. This chart illustrates the true footprint of a financed vehicle. It combines the sticker price with interest, depreciation, and the opportunity cost of that capital. Because new cars lose up to 20% of their value in the first year, negotiate the total purchase price first, not the monthly payment. If you must finance, follow the 24-10 rule. 20% down, a 4-year maximum loan, and total car costs capped at 10% of your monthly income. Letting another owner absorb the initial depreciation allows you to invest the difference, which can be worth 6 figures over 10 years. These rules allow you to move beyond the aesthetic of the car and focus on the mathematical clarity of the trade-off. Rolling car payments are so normalized that they are the standard for neighbors and coworkers alike. In a consumer culture, what is considered normal rarely aligns with what is financially smart. Quiet wealth is often built by choosing a boring, sensible vehicle and using the surplus to acquire appreciating assets. Time is the essential ingredient for wealth building to work. Letting the car trap run indefinitely costs you both monthly capital and the years of freedom that money could have bought. Now that the mechanics are clear, the choice between the car and the asset belongs to you. Subscribe for more breakdowns based on math rather than hype. If you want to see a rent versus buy analysis for your city, let us know in the comments. Thank you for watching. We'll see you in the next one.